Hi, how are you? Let me start off with a very simple question to which most of you probably know the answer. What's the most valuable company in the world right now? Think about it. Many of you would guess ExxonMobil. Some of you might say Apple. You'd be a little out of date because Apple lost that title. Some of you would say Google's getting pretty close to the most valuable company in the world. But I would argue that when you make those statements, what you're thinking about is the market capitalization of the company, which is the market value of the equity in a company. At this point, you might say, well, what's the difference? Market value of a company, market value of equity in a company. I think there's an incredible amount of confusion about what exactly value is and how you measure it. In fact, you see this often when people use multiples. You'll see price earnings ratios, you'll see enterprise values, you'll see market values, you'll see value of the firm, value of the operating assets. So what I thought I'd do in this webcast is kind of disentangle all of those different estimates of value. To do this, I'm going to start off with a very simple balance sheet. But this is not a traditional accounting balance sheet, it's a market value balance sheet. So on the right hand side of the balance sheet, you see the only two ways you can fund a business: debt and equity. Well, technically, there could be a third slice, which is preferred stock, so leave it hanging in there. So basically, those are the sources of your capital in market value terms. On the asset side of the balance sheet, there are the operating assets of your company, which for Apple could be the iPad, the iPhone. For Microsoft could be Windows and Office. But essentially, it will reflect whatever the operating assets of the company are. And then I'm going to bundle all of the remaining assets of the company into cash and other non-operating assets. I'll take those apart, but if you look at a company like Apple, you can already see that isn't penny change. You're talking about $150 billion in cash. So you've got debt and equity on one side, cash and operating assets, everything stated in market value terms. In fact, this market value balance sheet is going to allow me to define the three broad measures of value. Here's the first one. If you ask me what the value of the firm is, everything that the firm owns, then I'm just going to add debt plus equity, and what I'm going to get as my sum, if I add the market value of equity and the market value of debt, is the value of all of the assets of a company, both its operating assets and its non-operating assets, including cash. Well, you might say that's too broad. I want to find out just what the value of the operating assets is. Not a problem. That's easy enough to do. All I'm going to do in order to get the value of just the operating assets is I'm going to bring cash and non-operating assets to the liability side of the balance sheet and net it out from the sum of debt and equity. What I'm going to get is the value of the operating assets. That, in fact, is what enterprise value is trying to measure, is the market value of the operating assets, which will include fixed assets, intangible assets, working capital, all those classic measures of assets. So we've gone from firm value to enterprise value. Let's make one final stop. What if you wanted just the value of equity? It's easy to do. Take the cash and non-operating assets, add the operating assets, subtract out debt, you got the value of equity. So the value of the firm is the value of the entire firm, including cash and the market value of operating assets. The enterprise value is the value of just the operating assets, and the market value of equity is the value of just the equity slice in the firm. Without even looking at the numbers, you can see that the three can be very different, and we'll talk about the conditions under which they can be very different. If you have a lot of debt, your enterprise value can be a high number while your equity value is a low number, right? If you have a lot of cash, your firm value could be a high number and your enterprise value can be a much lower number. So I think we need to be careful about what measure of value we're talking about. So in order to kind of go a little deeper into this, I'd like to take the key items here: debt, equity, and cash and non-operating assets, and talk about what's supposed to go into them. Let's start with equity. Now, traditionally, when people think about market value equity, they think about market capitalization, which is the share price times number of shares outstanding. 30 years ago, that might have been all you needed to get the market value of equity, but let me add some clarifications here. When you talk about the market value of common shares outstanding, you should be including all classes of shares. Again, that used to be unusual in the US, but increasingly companies have multiple classes of shares with different voting rights, different dividend policies. The value of common stock is the value of all of your different classes of shares. You might say, what if one class of shares is not traded? Make your best estimate of what the price should be, multiply by the shares outstanding. Point of clarification: when you're estimating the value of common stock, and if you're going to estimate the value of options separately, which is what I think you should do, then you should be counting only the actual number of shares outstanding, not the fully diluted or partially diluted number of shares. So for the moment, take the shares outstanding, multiply by the share price, and as US companies increasingly turn to restricted stock units as employee compensation, restricted because these employees are not allowed to trade on them, count them as shares outstanding as well. That's the market value of common stock. For many mature companies, that's going to be pretty much it. But if you're valuing a technology company or a young company, make sure you count those options that are outstanding. Now, I like to treat options as options, value them as such. If you don't have the information or the stomach for doing that, value them based on exercise value. What would you get if you exercise these options today? Add that on to the value of equity. And finally, if you have conversion options, again, very common in growth companies, in your bonds and preferred stock, that conversion option is equity. And if you can strip it out and estimate the value of conversion option, that should go into equity as well. So in sum, the market value of your equity, if you think about all equity, should be common stock. It should include employee options and should also include conversion options and all of your other securities. What about debt? Again, let's start with the standard debt that you think about. All interest-bearing debt, short-term as well as long-term, should be counted as debt. Now, again, the right thing to do if you're doing a market value based assessment is to get a market value for the debt. Some companies are starting to report that in their financial statements, but most companies report just book value of debt. There's a simple way to compute market value of debt, which I've gone over in previous webcasts, and it's easy to compute book debt. Lease or contractual commitments, and usually companies will reveal what those commitments are in the future. Take the present value of those commitments using your pre-tax cost of debt as your discount rate. Pre-tax because those lease commitments are pre-tax. Again, there's a different webcast that goes through this process, but what you get as a present value should be added onto your debt. Saying, what about capital leases? Well, if you have capital leases, they're already being treated as debt. Don't double count by converting them to debt and adding them on again. Now, here's a ticklish item. What if you have underfunded pension or healthcare obligations? Increasingly in US companies, you see this line item show up. If these liabilities require you to come up with fixed payments in the future, in other words, if you have an underfunded pension plan and that requires you to legally come up with fixed amounts every year for the next 5 years, treat them as debt. If not, it's best not to treat them as debt. So we've got the market value of equity, we've got the market value of debt. Let's talk about what goes into cash and other non-operating assets. Cash should be simple, right? But many US companies increasingly have started breaking down cash into cash and short-term investments, count them as part of the cash balance. Here are a couple of quirky issues. In some cases, companies need cash to operate. In fact, most companies need cash to operate, but most of the companies that need cash to operate can usually earn a fair rate of return on the cash. You're saying, but that's a really low rate of return. Here's my definition of fair. If you invested in something liquid or riskless right now, what rate of return would you make? And the answer is almost nothing. So if your company makes only 0.2% on that cash balance, it's earning a fair rate of return. But if you're a business that actually requires ready cash, currency sitting in the tills, then it's okay to take that cash out of your cash balance. It shouldn't be a large number. So if you're taking out $1 billion, $2 billion, or $3 billion as operating cash, something is wrong. Something is wrong with your company. Maybe you're looking at a business which is a very strange business, but that shouldn't be happening. Okay? If some of the cash is trapped, and this is a peculiarly US phenomenon, what I mean by trapped is US companies that make cash overseas don't have to pay the differential tax rate until they bring the cash back to the US. Not surprisingly, they leave the cash abroad. So you might see $100 billion of Apple cash is held abroad. The problem is the minute they bring it into the country, into the US, they'll have to pay an additional 15 or 20%. If you want to be conservative, you can net the taxes out of the cash, but that's assuming they will bring the cash back and they'll pay the differential tax, and I'm not so sure that they will do that. For the other non-operating assets, don't get carried away and start including things like goodwill and intangible assets and brand name value. That's not what this is meant for. This is meant for investments in other companies, minority investments, small investments you're making. I'll come back and talk about what to do about majority investments, because there you create a different kind of problem. But this is for 3, 5, 7% of another company. And the reason you got to come up with a value, some measures of value require that you take these non-operating assets out. So if you can get the market value of these holdings in other companies, get them. If not, you're kind of stuck with book value, which might not be a great proxy for the value of those assets. So here's why we care so much about how the value is estimated. One of the first rules in multiples is you got to be internally consistent. What I mean by that is your numerator and denominator have to be matched up. So if your value estimate is the market value of equity, If you're trying to compute an earnings multiple, your denominator has to be an equity income, a net income, or earnings per share. So price earnings ratio, classic example of an equity earnings multiple. If you're coming up with a book value multiple and market value of equity is the numerator, then all you should be counting in the denominator is your book value of common equity. If you're looking at revenue divisors, market value of equities really should never be divided by revenues because it's not just the equity investors who create the revenues. Now, if you have firm value, which is market value of equity plus market value of debt, if you're looking at earnings divisors, you can start with operating income, EBIT or EBITDA. But you have to add the income from cash and cross holdings to that, because if you don't do that, your numerator will include the value of those cross holdings and the income and the cash, and your denominator will not include the income. So it's kind of it's an adjustment you need to make, not always easy to do, but that's what you need as your earnings divisor. If you're looking for a book value multiple, then you're going to add the book value of equity to the book value of debt in your denominator. And again, there's no consistent version for a revenue multiple. If you're doing enterprise value, which is market value of equity plus debt minus cash and non-operating assets, then your earnings divisor can be either operating income or EBIT or EBITDA. Both work. They're both consistent. If you're looking for a book value multiple, your denominator has to be a book value of invested capital. So what the heck is that? That's book value of debt plus book value of equity minus cash minus book value of cross holdings. So see, if you look at what I'm doing, I'm essentially matching up my numerator to my denominator. And revenue multiples work fine with enterprise value. You can even divide enterprise value by the number of subscribers, the number of members, the number of users you have. I'm not saying they're great multiples, but they're all internally consistent. If you include leases as debt, then you have to adjust your operating income and your EBITDA for the fact that leases are now being treated as debt. For EBITDA, it's easy. You just add the lease payment or the rent expense for the current year to your EBITDA. If it's EBIT, then you got to go through that more involved adjustment where you add back the lease expense and subtract out the depreciation from the leased asset, which I've gone through in a different webcast. And when you do the divisor for book value, make sure you include the present value of lease commitments in the book value of your invested capital. And revenue multiples again work fine because you can just divide that enterprise value by revenues. You can divide by subscribers, members, users, etc. Just to give you an illustration of how numbers can change, here's what I did. I ranked companies based on different measures of value in this table. So a couple of months ago. If you look at just market cap, you are right. ExxonMobil is the most valuable company. Apple is the second most valuable company. Then comes Google, right? If I look at firm value, the rankings change. The number one company becomes GE. And there's a very simple reason for that. GE has an immense amount of debt. So if I look at the value of the entire business, including debt, it becomes a much more valuable company. If I look at enterprise value, then the most valuable company again is GE, because even if I net cash out, GE stays up on top. So the rankings, and you can compare the individual rankings, do shift depending on what measure of value that I use. So when you sit down, when somebody talks to you about the value of a company, at the risk of sounding stupid, ask them to stop and tell you ask them what measure of value you're talking about. Because without knowing whether they're talking about equity value, firm value, or enterprise value, you're going to be completely lost. Now, having put those slides behind us, let me take you through a very simple Excel spreadsheet I created to kind of make this process a little easier. What I'm going to do is take Disney on October 25th of 2013 through the process of estimating different measures of value. So I'll put the spreadsheet up online. There's the name of the company, the date that I'm doing it, so I know when I did this. I put the risk-free rate on that day in there. Now come the numbers for the company. As for the number of shares outstanding, and I've put primary in brackets. What I mean by that is I want the actual number of shares outstanding. You're saying, what if I have 2 classes or 3 classes? Then sum up all the classes, put them together as the total number of shares. And the price, if you have multiple classes, should be the average price across all those different classes. The number of shares times the market price is going to give me the market value of equity. Right below it, ask for book value of equity. This is the shareholders' equity in your balance sheet, including paid-in capital, retained earnings, with everything in there. Okay. Now, I ask you, do you have employee options outstanding? And again, you can say yes or no. If you say yes, then you got to give me the details of options outstanding. U.S. companies should reveal this somewhere in their footnotes. In Disney's financial statements, they tell me there are 54 million options outstanding, with an average strike price of $32.02. I usually have the life of the option because employees exercise their options early. So if it's 5.1 years, I use 2.55 years. Then I enter standard deviation. Many companies actually give you the numbers they're using, so it's not a big deal. If an average company, that number is going to be about 30%. For a risky company, it can be 45 or 50%. So don't get too carried away. It's not going to make that much of a difference to your value. Then I ask you for the dividend yield on the stock. So basically, that's a dividend per share divided by the stock price. And right now, Disney's dividend yield is about 2.35%. So that's the equity data. If you have preferred stock, I ask you to look up the book value, which is what you see in the balance sheet. And if you can, if these preferred shares are traded, I ask you for the market value. If you don't have market value, not a big deal. Just enter the book value as your market value. For the debt, I start again with the book value of interest-bearing debt. So I add the short-term debt that you'll find under current liabilities, which will be the short-term portion of long-term debt, the short-term debt, and the long-term interest-bearing debt. Put them all together, and that'll include the capital leases because they're usually treated as debt in your balance sheet. Put the book value in there. Then I ask you for an average maturity of the debt. Now, U.S. companies actually tell you when the debt comes due. You can actually see a table at the end of the footnotes that tells you debt due in 1 year, 2 years. So you can take an average maturity based on that. If you don't have that and you feel really uncertain about this process of converting the market value, enter 0 here. In which case, I'll just use your book value as your market value. I ask you for the interest expense on the debt that you get right off the income statement, and for Disney that's $383 million. And I ask you for a pre-tax cost of debt. If your company has a rating, you can look up the cost of debt based on the rating. But you can also use the synthetic rating spreadsheet I have on my website to estimate the rating and the cost of debt. But enter your pre-tax cost of debt. Then I ask you, do you have lease commitments? If you say yes, then I ask you to enter the lease commitments. Again, U.S. companies break down their lease commitments for the next 5 years, and then beyond year 5, they give you a lump sum. Just enter those numbers. I ask you for the lease payment in the most recent year as well. So those are right off Disney's statements. I entered those. Then if you have convertibles, I ask you for information on those convertibles. So basically, if you have convertibles and if you have convertible debt, I ask you for the market value of convertible debt if you can get that. If you don't have that, again, just enter the book value. I ask you for the book value of convertible debt, which should be right on the balance sheet. I ask you for the coupon rate on the convertible debt and what the maturity of the convertible debt is. For convertible preferred, I again ask you for the book value, the dividend yield on the convertible preferred, and this, if you can do it, would be great. Give me a dividend yield on a straight preferred. I'll give you a very simple way in which you can make an estimate if you have no idea what to do. See the pre-tax cost of debt? You entered a few cells above 4.25% for Disney. If you ask me to estimate a dividend yield on straight preferred for Disney, here's how my reasoning will go. If my debt holders are demanding 4.25%, to lend money to me and preferred stockholders are behind them in line, then the preferred dividend I have to offer has to be higher than 4.25%. How much higher? Well, it depends on how much interest expense I have and whether I'll get to the preferred dividend. The case of Disney, because their operating income is so high relative to their interest expense, it's going to be maybe 4.5% as your cost of preferred stock. You're saying that's so subjective. It's okay. All I need is a subjective judgment from you on the preferred dividend yield. Then I ask you for cash and marketable securities. Make sure you add the short-term investments that the company has. I ask you for cross-holdings in other companies, and that'll usually be a book value on your investments in other companies. You'll see a book value. Then I ask you, do you want me to convert to market value? You might say, what magic are you going to use? I'm going to use a very simplistic device. I say, use the price-to-book ratio for me to use. So for instance, if you know your cross-holding is in a chemical company, what you can do is you can go to my website, look under updated data, and you'll see a price-to-book ratio at which chemical companies trade at. Let's say it's 1.5. You can enter the 1.5 there. I'll scale up the value of your cross holdings using the price to book ratio. Very, very simplistic, but that's all I need for this process. Then if you go to the liability side of the balance sheet, I ask you to look for minority interest. Minority interest is very different from minority holdings. When you see minority interest on your balance sheet, it means that you've consolidated a subsidiary into your company and you don't own 100%. For Disney, the minority interest is actually the 20% of ESPN that doesn't belong to them and the portion of the Hong Kong Disney theme park that belongs to the Chinese government. Those are classified as minority interest. Disney gives me the book value. Again, I ask you, do you want me to convert to market value? And if yes, I use the price to book ratio to convert it. I'm pretty much there. Then I ask you for the operating data that I'm going to use for your multiple. So I ask you for revenues. Again, I ask you for the last fiscal year, the last 12 months, the expected revenue. If you don't have any of those, just enter not available, or just put in blank or not available. So you'll see EBITDA, EBIT, tax rate. Don't do any adjustments here for leases. I will make the adjustments for you if you have leases, etc. Then I ask you for an effective tax rate paid during the period. Then I ask you for net income, interest income. So basically, these should come right off your financials. Then I ask you, do you want me to capitalize R&D expenses? Not a big deal for Disney. It doesn't have R&D, but if you're a pharmaceutical or a technology company and you answer yes, then I ask you for information on R&D expenses. That's pretty much it. Here's what I do once you give me the numbers. I compute the market capitalization as share price times number of shares. I value your options, essentially with your inputs in the option calculator built into the spreadsheet. And if you have conversion options, I compute the value of those conversion options, and I do it in a backhanded way. Basically, if you have convertible debt, I just value your convertible debt as if it was straight debt because you gave me the coupon rate, and I take the difference, the conversion option, as my value of the as equity, and I do that for preferred stock as well. So that conversion option is 0 for Disney because it has no convertible securities. Now for the debt value, I convert your book value of interest-bearing debt to market value. And remember again, if you don't want that to happen, just enter 0 as your maturity and your book value will become your market value. I convert your lease commitments to debt, and there's your market value of all debt. In the case of Disney, there's no preferred stock, but if you did have preferred stock, I'd compute that as well. And then I compute the market value of the entire firm. I take the market value of equity plus the market value of debt plus the market value of preferred. Okay. And if you add them all up, you get the market value of the entire firm. So 125 plus, so that's what you see as my bottom line number, is the value of equity plus essentially the value of the debt. If I subtract out cash and I add back the minority interest, I get the enterprise value. Right? So basically, the enterprise value reflects the value of the operating assets. The firm value reflects the value of the entire firm. Okay? So that's pretty close to where you need to be at this stage in the process. Okay? Now for the book values, because you gave me those numbers, I added up the book values as well. And the book value of invested capital is debt plus equity plus preferred minus cash. There's my invested capital. Then I use the numbers you gave me, adjusted. So basically I do the adjustments. So if you look at your EBITDA, EBIT in this table, it will not look like the numbers you gave on your input page, because if you have leases and R&D, these numbers are adjusted for those. If you have no leases and R&D, they should match up exactly. Then I compute pretty much a whole range of multiples you might be interested in. So including one variant of the PE ratio, where I take the market value of equity and subtract out the cash, and I take the net income and subtract out the interest income from cash from it. And to compute the interest income from cash, I just multiply the risk-free rate by your cash balance. Again, a very simplistic proxy, because the risk-free rate is a long-term rate and you probably earn a short-term interest rate on your cash. So you can change that if you want. But essentially, this is a process of going through the numbers to make sure that the numbers are consistent. That's pretty much it. Thank you very much for listening, and I hope this webcast helped you make sense of the different estimates of value out there.